With me now is Stephen van Coller and Megan Pydigadu, the CEO and CFO of EOH, respectively. Thank you very much for your time. And obviously, it has been a relatively busy period, given the fact that you have just announced your results. Stephen, let's start with you on the fact that you have announced now that you're going to go to the market to raise capital. Everybody's waiting, has been waiting for the strategy in terms of your optimal capital structure. I suppose the key question is that EOH has been very difficult to understand in the past, especially with the changing elements as you have disposed of assets, etc., etc. And can we clearly say now that all of the bad news is out? You're not going to be doing any more disposals. It is what it is. This is the EOH of the future in terms of the base that you've established.
Yeah, thanks, Bronwyn. As you know, this has been a process for the last 3.5 years, and we had to do it step by step. And obviously, COVID delayed us a bit, and trying to you can't speed it up. It is what it is. And so we've sold businesses that were not part of the core. Some were good, some weren't good, but we had to do something and we had to act early. And that's really what we did. We acted early, paid the debt down, and thank goodness we did, because with rising interest rates and the economy like it is, we're actually in a lot better shape than we could have been if we had delayed all of that. But we always said to people we had to get through the main sales. Once we've got through that, we will then have sorted out the core. And you saw the core actually growing nicely in terms of revenue. We had one difficult business that was flat year on year, but the rest were all good, which is great. And that's been a huge effort. But the reality is you can't go and do a rights issue until you've got an investable business case. And so the banks would never allow us to go out, and the board would never allow us to go out if it wasn't an investable business. And this turn to profit, 282 million rands worth of operating profit, 92% up year on year. This is the fundamental base to be able to go and launch this rights issue. The next thing, so this was always part of our plan. As you know, we announced it in January that we were going to do it, and it was just getting to the brass tacks of it. But now we can go forward. A 6 billion rand turnover business, doing just under 500 million of EBITDA and making an operating profit of just over 100 million rand. That is the base. There might be one or two small things and small adjustments, but at the moment, that's the core or continuing business, as we call it, going forward.
And Megan, if I can ask you to elaborate on what Stephen has said, the stable base, your expectations on growth into the future, and also perhaps just some disclosure around your expected profitability going forward from the stable base.
I do think we've set a good base case in terms of where we're at and what the equity story looks like for EOH. So just from a high level perspective, if we look at the normalization of our results, we've seen just under 6 billion of revenue, just under 500 million of EBITDA at an 8% margin, and then 112 million of profit after tax. And so if we take that base and project going forward, understanding that, as Stephen said earlier, that we did see some underperformance in our Nextec business, and that business made, the business digital infrastructure made about a 40 million EBITDA loss. If we just get that to break even, you can start to see what type of EBITDA margins the business would do. So in the medium term, we would expect to see the business getting to around 10% EBITDA margins. And then also, if you look at the ICT sector generally, we normally grow at GDP plus 2%. And we, as a market share, have 5.5% market share in South Africa. Probably about 5 years ago, EOH did have around 10%. And so we'd like to see ourselves growing back into that market share. And we definitely believe there is opportunity, especially with the fact that the whole onset of COVID and working from anywhere has really accelerated a lot of businesses' digital journeys. And I think we sit at the heart of that, being able to support and solve those problems for our customers.
So as Megan says, Stephen, the business has made great progress from an EBITDA level perspective. But if you really drill down into it, your profits after tax aren't there. What are your expectations going forward?
Two things. One is we're paying an extortionate amount of interest. We're paying a 15% interest. And I suppose that adds into the business case for, or the investment case for a rights issue, because that's the floor of the return you will get. You get a minimum of 15% for every cent of debt you pay down. So that's a pretty exciting opportunity if you think about the long-term JSE return as 14%. So that's the first thing. If we reduce that just to a normal capital structure, and you'll see Megan's slides talk about on an annualized basis 65 million rands worth of interest and bank costs instead of 200. And then secondly is, now that we have signed our agreements with the bank, we can actually go ahead with our corporate restructuring, and that means less legal entities, more efficiencies around income. You haven't got some loss making and some profit making, which gives you, we made an 18 million rand loss and we pay 70 million rand of tax. It just doesn't make sense. So just those two things alone, if you sort them out, adds on its own 100 million rand back to the profit line. So quite excited about that, just to normalize the business finally and get out of these shackles that we've got from our group of 4 lenders.
Normalize the business and get to the stable base. I mean, that's the verbiage that we're hearing. Megan, can you confidently say that the legacy issues are behind you and that we will see no further impact on the income statement?
So we've really worked hard to close out the legacy issues. I think in the past year, all our legacy public sector contracts are a thing of the past and closed out. In terms of the provisions that we have on our balance sheet at year end, we've got around about 340 million of provisions. Those largely relate to 3 things. Firstly, the over invoicing on licenses related to Department of Defence and Department of Water and Sanitation. The Department of Defence we closed out 18 months ago and have been paying that over a 3-year period. And then the Department of Water and Sanitation, we're very close to signing those agreements and closing those out. We would expect to do that before the end of the calendar year. And then we've got some onerous provisions related to effectively warranty claims in some of our Nextec business where we've got 6-year warranty periods. The last remaining item is our PAYE issue that actually goes back to 2012 with SARS. We've tried on numerous occasions to try and resolve this item, and we've ultimately instituted high court proceedings to try and see if we can find some type of settlement with SARS. And then I think all the issues of the past should be behind us and we can look forward to our growth strategy.
Stephen, let's talk a bit about the EOH brand. There does appear to be some negativity still around the brand. Is this does it still affect your suppliers, your customers, or is this really just a storm in a teacup in terms of some of the press coverage we're seeing of late?
Yeah, it seems to be that the negative press comes every time we put out good results, and it seems to come from the same quarters. So we got a lot of positive press. Unfortunately, there were 2 negative press articles, but I think some of that is just what it is. Fortunately, I mean, our investment community, especially our shareholders, very, very positive on our roadshow, very happy with what we've achieved, very happy that we've managed to turn the company around back to, a large operating profit. I think it was quite a massive turnaround, actually, and we have to be proud of that. Otherwise, we wouldn't be able to go on a rights offer. In the last year, I haven't seen it affect our customers at all. In fact, as you saw in our numbers, they're coming back stronger and harder with bigger and longer term contracts. And certainly, we don't even get the questions from our shareholders anymore. So I think they've moved on.
Megan, let's go to the rights issue. You're going to the market for 600 million rand. This is very, very close to your market cap of 700 million rand. Perhaps a little insight into how the money will be utilized. and further the growth ambition that this money will go towards spurring?
I think it's important to understand our current debt position and with the lender group that we have. And it's been very onerous on us to do anything from a business perspective. So if we're able to unlock that, firstly, the bridge facility is at 15% interest, which Stephen spoke about earlier. Just unlocking that and repaying 600 million of the debt of the bridge facility will unlock a significant amount of cash that's been going to pay to the bankers. And we basically would expect to see 120 million additional cash unlock from reduction in interest costs. And then be able to redeploy that back into the business. I think the second point that's important is we should be able to refinance our debt package with our lenders. And by doing that, we should be able to go to a single banker. We should also be able to see an improvement in terms of what we're paying on our senior term facility. And that should bring further savings from an interest cost. And the last point is that we've had a lot of governance around anything that we've wanted to do in the business has very much been us having to go to the lenders to ask. If we can unlock that, it will also enable us to be far more agile and respond and adapt to changing marketing conditions.
Stephen, finally, Lebashe, you have said, is putting in 100 million rand in terms of the 600 million. What is the structure of the 100 million rand? Is it similar to their existing deal?
Yeah, so actually they're putting in about 160 odd because they're following their rights on the 500 and they own 14% of our shares. So 14% of the 500, they'll put it on the rights offer. On the 100 million, that's an extra strategic partnership deal. So just on a 1-for-1, if we double the number of shares in issue, they would end up with around 22% actual shareholding. Very similar to the deal that was done in 2018, where they will have these A shares which give them extra voting rights. Clearly, they'll have half the extra voting rights that they had in 2018, but still has a warrant based on if they add strategic value and we outperform at a CAGR of 25% over the 5 years, they get an extra return. But that dilution in worst case is less than 3%. But no one should worry because if they've added that kind of value and we've grown that kind of speed, everyone will be doing incredibly well at that point in time. So they're very committed, and they always had the right to have 2 board members. They've had one up until now. They will definitely put the second board member on, and we're already having discussions around how this partnership now rolls forward. And they've definitely put our past behind them, even though they were rather hurt by it. But very supportive of the new management and board.
Just a final question, Megan, in terms of the roadshow that you have just executed from a results perspective, how are existing shareholders responding to the rights issue?
So it's actually been quite interesting that we've had a lot of positive feedback from existing shareholders. Obviously, it hurts in a rights issue to lay out more cash, but I think they can all see the rationale and the equity story. I think that's been one of the most positive feedback we've gotten, is because it has been really difficult to understand the EOH story. And I think they can now see like a clear story in terms of what EOH looks like and what the opportunities going forward also are.